Hey guys, how's it going? And thanks for coming. I'm Nick, and this is Real Life Money, where we talk about real life and money, because schools aren't, so let's get started. So guys, for this video, we are looking at the stock market, a review of 2017. Now this is kind of relating to my normally scheduled weekly recap, so if you guys have been following us, welcome back. And if you don't know what I do for the weekly recap, we just look at the previous week in the stock market, see some popular news stories, see what kind of individual stocks are going on. We look at a couple mutual funds. Now, before going any further, I hope you guys had a terrific 2017. If you were investing in the stock market, you most definitely had a great 2017, which is what we're going to be going over. But today is December 31st. So we're almost there, guys, and if you're watching the video a little bit later, we made it to 2018. If those of you are trying to turn over a new leaf in 2018, trying to get a hold of your finances, definitely consider subscribing to the channel. I believe we could definitely just take money and make it work for us instead of working for the man. So let's get into it, guys. If we're gonna make 2018 our year, we gotta look at what happened in 2017. So I normally go into detail of each individual stock and mutual fund and index. I'm kind of giving an overview of everything. So first, I just want to show you guys what happened for this week. So first, looking at the Dow, and of course the other indexes we'll look at. But at the very end of trading on Friday, everything dropped. Just because it was probably the end of day, people were getting out. It was the end of the year, and they were kind of just taking their profits, and because people are kind of unsure. So there was definitely a drop for there. You could see with these other indexes as well. Now this drop was kind of insignificant if you look at the actual year-to-date returns, which is what we're going to be looking at. They were incredible. So I'm going to show you in an Excel format sheet thing that I created for you guys that we normally looked at, the stocks that we normally look at, and also what the market did. We have been doing this weekly recap for 21 weeks. That is just over 5 months. I had to think about that for a second. But so we're going to be looking at what we would have returned in those 21 weeks versus if you got in at the very beginning of the year. All right, so this is what I got for you guys. You can see we have our stocks that we normally looked at on the left hand side, and we have some columns. So of course, Apple, Disney, Facebook, Google, Starbucks, and on the bottom were a couple index funds and mutual funds. Next column is just the price of whatever they closed at on Friday, so nothing too crazy there. Now, we could see their 21-week return. Looking at Apple, they returned over 8% in 21 weeks. Disney was slightly down, basically kind of flat. Facebook up 4%. Google 13%, and Starbucks around 3.5%. So the average of all of those guys put together was 5.73%. If you guys invested in these stocks 21 weeks ago, that was your average. Now, looking at the funds that we have lower down, that was the S&P 500, the SPY. That's an index fund of the S&P 500. For the 21 weeks, we would have returned 7.89%. The next one was Fidelity Contra Fund, just under 3%. And they did drop in the recent month because it was the end of the month. People were probably taking profits. And the, whatever you want to call that, last one, that was following the small cap funds. So that returned around 7.25%. That average was around 6%. So that was just 21 week, guys. Just like we said, just over 5 months. This whole year, basically every single month was an increase. So we did miss out on the first 6 months, and we're going to see the year returns were phenomenal. So it is definitely kind of better to get in sooner rather than later. Try not to time the market A lot of people do, a lot of people fail. They say to just get in, and like what I always consider or suggest is to make monthly contributions. So every single month, just put money into an account, doing like an automatic transfer, and it gets put into the market without you even knowing. So, going back to the chart, same exact setup, same exact stocks. We're just going to be looking at the 1 year returns. So, Apple returned, these numbers are friggin' awesome, by the way, okay? So, Apple returned just over 46%, Disney just over 3%, Facebook just over 53%, Google around 35.5%, and Starbucks almost 3.5%. And that average was 28.33%. So obviously, guys, huge difference compared to when we invested in it versus the beginning of the year. So that's why I would suggest start now. If you have any time to start, don't try to time it, just get in, all right? Especially for the long term. Yes, it can go down short term. Don't worry about it, all right? So, we can see a little bit further down the funds that we look at. So the S&P 500 1-year return was 19.38%. Fidelity Contra Fund, huge difference from when we looked at it, of when we started owning it, but almost 32%, and the small cap fund of around 11.25%, and that average was 20.83%. So whether you agreed with these stocks or not, whether you think I'm an idiot or not, it doesn't matter. This is a learning experience. So you could see, a few stocks did very, very well, and a few stocks kind of didn't move so much. So it's kind of a good and bad thing of diversification, meaning holding multiple investments. So diversification is a good and bad thing, guys. Like we saw, Facebook was the best returning stock of the stocks that we looked at, over 50%, but no one knew that. It's not like you could have stuck all your money in Facebook and be like, oh, this is going to be the best investment this year. So that's why diversification is good. You have a bunch of things out there. The ones that do bad are held up by the ones that do good, but at the same time, the ones that do good are held down by the ones that do bad. Another good example of, if you have no idea where to start, if you're not even interested in the stock market, you just want to make money with it, that's why the index is a pretty good bet. Just the S&P 500, their returns were very good this year. You didn't even have to do any type of research. You just mirror the market, and it returned almost 20% better than some of the stocks that we had. Now, a very, very, very important thing, guys, that I want to portray to you is that this year was phenomenal. Very, very good, and it is not the average return of the market. This isn't going to happen the next year and the next year and the next year. Can it happen like maybe in 2018? Sure it can, but it's not going to be like this every single time you invest. And I fear that a lot of people kind of think that way, because everything in the market basically went up. There was like no downside. So basically every investor who invested in the market this year thinks that they're like Jesus. Now, if you made good money in the market this year, great for you. I'm proud. However, it's not probably going to be a consistent thing. Unfortunately, of course, we would all want this every single year. But the average return of the market, if you look at the history, not to be a downer, this is the reality of the market, guys. The average is between like 7 to 10%. This year, it's like double, triple of the average. Now, the funny and interesting thing about 2017, guys, just because we're in a long bull market, markets have been positive for the past like 7-8 years. People thought, for years they've been thinking this, could there be a correction? Could there be a crash? And they hesitate to get in the market. Well, if you thought that in the beginning of this year, guess what? You missed out on these incredible gains. So that's why I believe you should always, at least in some percentage or extent, you should be in the market. And if it does crash or it does correct, then I would suggest getting in even more. Speaking of crashing and is it possible, of course we gotta mention Bitcoin. I forgot to go over that in the beginning of the video. Bitcoin this week, you could see when I took this picture, it was around $14,000. Again, I'm not an investor in it, probably will never be, but there was a huge drop in Bitcoin. You know, it was at one point almost hitting 20,000. Now it kind of crashed a bit. So for these reasons, you know, with Bitcoin, people think, is that a bubble? Could that crash? The stock market is up, doing great. Could that crash? And a lot of people thinking that for 2008. So no one knows, by the way. It's not like no one has some crystal ball or some special insight for them to actually know. When a bubble pops, it's just out of the blue. Now we cannot forget the tax reform, the new tax reform going into effect for 2018. It might not realize its full effect until 2019, but that's a huge tax break, like I say basically every week, with that drop of 35% corporate tax rate down to 20, technically 21, but that's a huge gain for businesses. So could that make the stock market do good? So there's a bunch of different factors going into 2018. It could be another great year. There could be a correction. So that's why no one really knows. I would suggest always getting into it. For the long term, should be fine. So if you have any questions, comments, concerns, please leave them down below. I'd love to hear what you guys think and what you think what's going to happen for the next year, if you did good for this year. And look back to that little chart that I made up for you guys. You could kind of make some observations about it. Maybe an index fund is better for you guys if you don't want to do any type of research at all. But there is a payout if you pick the right companies. So be careful, do your research, and don't forget to subscribe to my channel, Real Life Money, where we talk about real life and money, because not many people are. So thank you so much for watching, guys. Have a great new year. This is going to be the year, I can feel it, and I'll see you in the next one.